Welcome to Market Week in Review for the week ending December 3rd, 2021. I'm Chris Kyle, and today I'm joined by Chief Investment Strategist Paul Eidelman. It's been a busy week, hasn't it, Paul?
Sure has. How are you, Chris?
Doing well, thank you. Well, considering the holiday and not recording a segment last week, I think we should jump right in. Obviously, two of the top stories this week were comments from the Fed on tapering, as well as the Omicron variant. But since we covered those earlier this week with a blog post, let's pivot towards equally recent developments such as November unemployment data and market volatility. So this morning, we saw a few different unemployment figures with payrolls and the unemployment rate standing out the most. Walk us through this data and really what it's suggesting about our current labor market.
Yeah, I think it was a messy jobs report because you probably got a different take from it based on which number you looked at. I think in a general sense, the overall tone was a positive one, but to kind of dig into that, the headline number that probably gets the most attention is the non-farm payroll. So that came out at 210,000. That was a miss relative to the consensus expectations, less than half of what economists were looking for. But you really do have to look at the entirety of the data set, and the separate survey of households, the one that gets used to calculate the U.S. unemployment rate, was exceptionally strong. And so like on an equivalent basis, when you stack the surveys as best as you can next to one another, that showed almost 2 million jobs being created in November. And because of that strength, the unemployment rate fell very sharply from 4.5% down to 4.2%. So that surprised all of the economists to the upside. So it ended up being a bit messy. When we kind of step back and try to ask, what does this mean for the U.S. consumer and the economy? I think it is ultimately a positive message, particularly over the last 3 months. It's been an environment of healthy job growth and robust wage growth, which collectively is kind of boosting household income at almost a double-digit pace right now. And so I think that keeps the U.S. consumer on solid footing here as we start to push really late into the fourth quarter of 2021. So I think broadly speaking, both the U.S. and global economy, with some data points from business surveys this week, is looking pretty good, at least through November.
Yeah, completely agree. And one aspect of what we've seen this week, though, are equity markets. They've edged lower. The Treasury yield curve has been flattening. Are these reactions warranted? And what should we expect during these final weeks of the year?
They probably are warranted. And there's a tension between the backward-looking economic data, which is looking really good, and some clouds on the horizon in terms of what this new COVID variant means for the outlook, and also the pivot from the Fed turning a little bit more hawkish. And so that created quite a bit of volatility in financial markets, almost a roller coaster ride in equities. If you go back to last Friday, I think we were sort of down, up, down, down, up, down. But the net experience of that has been down. And so for the S&P 500 index, we're trading off about 4% from the highs in mid-November. And similarly for the MSCI All Country World Index, we're down about 5%. So markets are pressured. I think there are some growth concerns and some concerns about what higher U.S. interest rates might mean for share prices. And as you were kind of noting as well, there's been some movements in the interest rate curve as well. So long-term Treasury yields are now down close to 1.4%. And the curve flattened because of those expectations about possibly sooner Fed interest rate hikes. And, I think this is an interesting time. It's a quite uncertain time. Forecasting what's going to happen next with COVID is borderline impossible. And I think in these kinds of environments, it's really important for clients to stick to their long-term strategic plan. Staying invested in times like these when it's scary is one of the most important ways to have success over the long term and help meet and exceed your goals and outcomes.
Well, I think that we'll all try to be cautious, especially during this holiday season, and we'll stay put going into the new year. With that, though, thank you for this time this morning, Paul. Enjoy the weekend, and to all of our listeners, stay safe and be well.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.